Factor authorization stress and common investment mistakes. This is Ken Boyd with the Accounting Accidentally Substack page. And just a reminder that I'm posting a text version of this entire book on Substack and video versions on YouTube. You can email me for details on my fifth book's publishing date, late 24, early 25. So I feel like I'm trapped by two-factor authorization or 2FA, and I bet you are too. Seems like every app and tool that I log into now requires an extra code to log in, and I don't know how much time 2FA requires, but I think it's taken years off my life. It's a hassle, but 2FA is necessary to protect data, and turning off 2FA would be a mistake. I thought about doing it and decided I needed to keep it. So in a similar way, the huge swings in stock prices may have you wondering if you've made some huge mistakes, and that's normal when investing tensions are running high. To assess whether or not you're on track, here's my list of the most common investment mistakes people make. The first one relates to goals, forgetting your investment goal or not having one at all. So for starters, go back to the reason you were investing in the first place. Specifically, how much money were you trying to accumulate and for what purpose, for how long? For example, you're investing in a 401k retirement account and you plan to retire in 25 years. You'll be willing to take a moderate amount of risk. If your portfolio is up or down at 10% in 1 year, that's something you can live with. A 25% change, however, makes your palms sweaty. If you invest in mutual funds, you invested in mutual funds, 70% in stocks, 30% in bonds. That's a plan, and that's your starting point. What was the original goal? The second is unrealistic expectations, and I'll go back to a blog post I wrote in 2018. So in January of 18, the Dow Jones Industrial Average was up over 32% for the prior 12 months, and the Dow Jones is an index of the 30 largest corporate stocks. Similarly, the S&P 500, which is an index of the 500 largest stocks, think of a basket of stocks, was up almost 25% over the prior 12 months. Now, that's crazy record-setting performance, and it's stressful to consider that every bull market, a bull market is one that's going up, ends, and expecting a 25% plus annual rate of return is simply unrealistic, looking at it historically. It may seem like everyone around you is getting rich, but that's normal. And every bull market since the 87 market crash, most of us think that everyone else is making a pile of money. There's kind of a FOMO effect, but there's a trade-off. The people who are really killing it in the markets are taking more risk. Bitcoin, for example, has gone huge ups, huge downs in recent years. These investors either have a large percentage of their total portfolio in stocks, they're not diversified also into bonds and cash, or they're buying riskier stocks, those stocks that have less of a performance history on steady earnings and sales. So it's riskier stocks, or they're all in stocks and risky investments. So the solution here is to keep your head and realize that your goals haven't changed. Bull markets historically come to an end at some point, and when, not if, the bull market ends, you may incur some losses in the short term, but you can get through it. So all that being said, what is a quote unquote normal return on stocks? Well, Seeking Alpha is a great site that I highly recommend. It has some great stats on historical returns of the S&P 500 from 1928, really when the record started, to 2015. So over 88 years, the S&P 500 went up 64 years, down 24 years. So majority of the time it went up. The worst year was nearly a 44% decline during the Great Depression, 1931. The best return, 52.5%, 1954. So the mean, or if you can think the average, was a little over an 11% return. This also assumes that you reinvest dividends that you get. So let's also say that. So what's a normal return? Seeking Alpha says 11%. Other stats suggest 8 to 10% over that historic 70, 80% period. The point is that 24 to 32% is not normal. So accept the fact that over the long term, you're not going to earn more than historical or normal return. Risk assessment, another big one for me, is most investors don't think honestly about risk tolerance, and that word honestly is important. So to assess your risk tolerance, and I did it earlier in the post, ask yourself if your portfolio went up or down 10% in 1 year, is that something you could live with? What about 20%? You start to get an idea of what your tolerance is for risk. You get the idea. Use that knowledge to select your investments if you want a stock mutual fund with moderate risk. Read the fund's investment objectives and check the fund's historical performance. Is it consistent with moderate risk? Specifically, a stat that's used is beta, which measures the fund's volatility in comparison with the overall market. So you'd want a fund with a moderate beta. Succeeding once is random. Just ask that guy who just hit 21 on his first hand of blackjack at a casino. He may think he's a genius, but the law of large numbers removes randomness. Over time, the blackjack pair's results will shift back to a normal level. And in the same way, great investors succeed over the long term because over the long term, results are no longer random. So, final thoughts: have an investment plan and remove emotional decisions, particularly those emotional sale decisions. Invest in companies that consistently make money and hold those stocks. Timing the market doesn't work over the long haul. Don't try it. And invest in portfolio stocks and bonds that perform differently in up and down markets, which we'll get to later in the book, more on diversification. That approach will help you average out total returns over time. And remember to discuss all this with a financial advisor. That's as far as we'll get right now. And you can find all the other content from the book on Substack and YouTube. Thanks for watching.